All right. All right. So let's talk about actually how you use a forward contract and an option contract to hedge a receivable or payable. That's really what we're going to do. All right.
Are you going to copyright yourself?
Copyright Lou Gaddis, with help from Sam. All right. Sam, you're famous. All right. All right, so here's the goofy example we're going to set for this whole lecture here. PA widgets. Simple business model. 1 year from now, they are going to import widgets from Mexico and pay 20 million pesos, and then immediately deliver them to London and receive £1 million. That's their entire business. All right, nice simple business. You got that? They're going to pay 20 million pesos for their widgets and just ship them to London and get £1 million. So let's try to figure out what their dollar costs and revenue are, get their dollar profits, then talk about how they could hedge the receipt, hedge the purchase from Mexico and the delivery to pounds. All right, so 20,000 or 20 million pesos. I looked up the exchange rate from Bloomberg. There it is. There's the 1 year forward the 1 year forwards. So the bid ask on the peso is 18.80.045 bid and 18.8170 ask. So if they're going to pay 20 million pesos, they're going to multiply times the high because they're going to pay more. Right? You're going to get screwed in this bid-ask transaction. So we're going to get the highest dollar per peso exchange rate, which turns out to be 1 over the lowest peso per dollar exchange rate. The lowest is 18.045. So 20 million pesos times 1 over 18.8045, they're expected to pay $1,063,000 for the widgets. You okay? Good. All right.
That's in dollars.
That's in dollars. 1 year from now, they're also going to deliver them immediately to London. The bid-ask spread on the pound is $1.3083 bid, $1.3086 ask. That's right here. I just got that from Bloomberg. Up on campus, we have some Bloomberg terminals. So if they're going to receive dollars for this £1 million, you're going to take a pound times $1 per pound exchange rate. Since they're receiving it, they're going to get screwed in this bid-ask transaction. They're going to get the lowest dollar per pound exchange rate, which is 130.83. They will receive $1,308,000 in revenues. $1,308,000 revenues minus $1,063,000 costs. They're expected to make $244,000. You okay? Everyone feel good about that? All right, here's where it gets nasty. Not yet. A couple more slides. So let's do IMM on PA widget. Let's identify their exposure, measure their exposure, and then design a mitigation strategy with either forwards or options. All right, so what are they exposed to? Well, they're going to pay pesos, so they're exposed to an appreciation of the peso. They're going to receive pounds, so they're exposed to a devaluation of the pound. That's their basic risk exposure or risk identification. They're exposed to an appreciation of the pound and appreciation of the peso and a depreciation of the pound. You good? All right, let's talk about measurement. Well, they're expected to receive £1 million and they're expected to pay 20 million pesos. Let's do a 10% stress test. 20 million pesos times the dollar per peso exchange rate. Easy way to do it here, just multiply times 10%. There you have plus or minus $106,000 risk on the peso for a plus or minus 10% change in the exchange rate. This is actually an easier way to do it than the last slide. Just take the dollar value and multiply times 10% versus figuring out the 10% change in the exchange rate. Just take the dollar value times 10%. And they're plus or minus $130,000 if the peso appreciates or depreciates by 10%. Okay? So that's like a simple measure of kind of how much they can win or lose. However, let's calculate the cash flow at risk for both currencies. 20 million pesos times 1.65, that's that Z value for a 95% confidence interval, times the exchange rate volatility, standard deviation. So the number is now $198,000 for the peso. So what they say is the firm is 95% confident losses will not exceed $198,000 for changes in the peso. £1 million times 1.65 times the standard deviation of the pound. They're 95% confident losses will not exceed $181,000 for the pound, for the pound. Brian.
I just want to make sure I got this correctly. So we're saying the expected profit's $244,000.
Yes.
And we're 95% confident that the losses aren't going to exceed $198,000.
I'm sorry. The loss is just from the receivable or the payable. So you can so their profit is 244.
Yeah.
So actually, they're not going to lose money. I should restate that. Let's talk about this 198. They're 95% confident that the gain or loss from that payable will not be more than $198,000. They're 95% confident they won't pay more $198,000 more for that payable. They're still going to be okay because their profit's 244. On the receivable, their profit is 244 as the expected, but there's a 5% chance the revenues will be down 181. Maybe that's an easier way to think about it. There's a 5% chance costs will be 198 higher, and there's a 5% chance that revenues will be 181 lower. Is that a little better? All right, let's go back. There's a 5% chance. These are the revenues. What was the EAR on the pound? 181. So this is plus or minus 181. This is plus or minus 198. What was it? So that's what we're talking about, is just isolating, say, the pound risk, the revenue. There's a 5% chance that could be 181 less than that. And there's a 5% chance that the cost will be 198 more. I think that helps out a little bit. Rachel. I'm sorry, I didn't hear you. There's a 5% chance that the revenue will be 181 less, or it could be worse. There's a 5% chance it'll be 181 less or more than 181 less. It's hard to listen across this one. Yeah. Good. Good. So good question. Can I'm not, for this class, going to combine them. You can have a cash flow at risk that combines all the currencies. What you would actually have to have, though, is the correlation between the peso and the pound exchange rates. And you put them all together and it looks like a portfolio. So we're not going to do that. Yeah. You're welcome. Yeah, it's painful. Yeah.
So are you assuming that the import and the export are both happening in 12 months?
Yes. Yeah. So yeah, I had to make a goofy example just so it's one time period. All the cash flows happen in 1 year.
Okay.
Anything else? All right. So if you learn nothing about currencies, IMM, how do you measure any risk? Identify your exposure. How much can you lose as measurement? And what do you do about it as a mitigation? Those are your 3 steps. All right. So what are we going to do about it? Well, that looks kind of big. We're only making a couple $100,000. We could give up most of our profit. Right? There's a 5% chance we're going to give up most of our profit. That's the way of thinking about it. There's a 5% chance we'll have to give up most of our profit due to an adverse change in the exchange rate. Now, you could just say, screw it, it's immaterial. This is not immaterial. We got to do something about it, so you can't use that excuse. You could say it's unhedgeable. Say, for whatever reason, we can't hedge it. Well, that is not an excuse. It is very easy to hedge forward exchange. You just call a bank and say, I want a contract to buy 1 million pounds a year from now. What's the rate? 130, done. Send me a contract. Thanks. Let's go to lunch. That's all it takes. So that's not an excuse. Too costly? That's not an excuse. Forward contracts, they have a bid-ask spread, which is probably less than a penny. So that's not an excuse. Now, you could say you're macro diversified. What if this is a firm that sells to 100 countries and imports from 50 countries? Well, you might say, you know what, we have exposures all over the globe. Let's not worry about it. They'll offset each other. That's not the case. This is a company that has one product, it sells it, and gets revenues in one currency. So there's no excuse to actually not hedge it. So we're going to mitigate. And how we're going to mitigate is we're going to use a forward contract or an option contract. All right? Any questions? All right, here's where it gets painful. Little pain with the forward, little pain with the forward. Option, little more. All right? So forward contract. This one actually is pretty straightforward. All right, your firm knows they need to buy pesos and sell pounds a year from now, right? They need to buy the pesos to pay off their supplier, and they need to sell pounds when they get the revenue. So how do they actually get a forward contract? The first thing I would probably do if I didn't have Bloomberg is I'd probably just Google the forward exchange rate, right? But if you had a Bloomberg or knew someone had a Bloomberg, you just look at this screen and say, oh, I see on Bloomberg, looks like about 1880, 1881 is kind of like a fair price right now. So one thing to do is then just call your bank and say, hey, I saw on Bloomberg I can get 1881, can you match it? And if they say yes, you're like, oh, okay, that's probably a fair price. Or what you do is you look at Bloomberg and you call 5 banks and say, hey, what's the best price? I want to buy 20 million pesos next year. What's the best price you can give me? And just pick the best price. Or what most people do is you call 5 banks, get the best price, and then you just use that as leverage with your normal bank. You just want to deal with your normal bank. So you're like, hey, the bank, M&T gave me this price. It was a pretty good price. Can you match it? Yeah, all right. Well, all right, cool. Let's just do it. I'd rather just work with you. That's kind of how things get done. All right. So you look at exchange rates. You call a bunch of companies. And the other thing you can do is interest rate. You could do the models and do interest rate parity. It's an interesting story. Not that interesting, but in finance it's interesting. Initially, these 2 slides were from investing.com when I Googled the forward rates. However, when I went to investing.com, these numbers were really strange. They were a lot different than this. And just for fun, I just did interest rate parity. I looked at the treasury rate, 1-year treasury rate in Mexico versus the U.S., and I think there was like a few percent difference. So I'm like, oh, well, and theirs were higher. So I'm like, oh, the peso's got to devalue by a few percent. And that's what this basically is the peso devaluing by a few percent. Investing.com was like 5 times off that. That's why I went to Bloomberg. So I just want to warn you, the leading place when you get Google forward rates on the peso was absolutely wrong. And I think it has, I don't know why. It probably has to do with they can't handle 10,000 pips. That's probably like they set up a little algorithm to figure out what the exchange rate is based on the pips, and they couldn't handle 10,000 forward points, which is adding 1.0162. All right, so just a warning that everything on the internet's not true. You ever heard that? All right, so, when it's free, it's almost what it's worth, nothing. So I only reason I caught that is I just double checked it because I'm like, does that make sense? All right. Then I got get quotes from several banks, choose the best rate, and then what I usually just use that as leverage with my local bank and then sign a contract. So I sign a contract at 1881, seems like a fair price. It's my normal bank. He's a good guy. He takes me golfing sometimes, so I just go with him. All right. Now, here's what it looks like to set up the contract. You just say, so we're going to do 2 contracts actually. We want a contract to buy 20 million pesos for 1 year, and we want a contract to sell 1 million pounds. So we want 2 forward contracts. So those are my two contracts. Let's pretend you get exactly the price from Bloomberg. 130 and 18.8. That's just exactly what the Bloomberg price is. The best price in Bloomberg. By the way, how Bloomberg gets their rates is they do surveys to 100 banks, every day. It's updated every minute, and what they represent are the best bid and best ask in the country at that point. So if you get that rate, it's usually pretty good. So there you go. You just shake hands and you have two contracts. Now you're obligated to deliver 20 million pounds next year. I'm sorry, you're obligated to deliver 1 million pounds and receive, what was the other one? Pesos, and buy 20 million pesos. Yeah.
So this would guarantee your profit of 244.
Absolutely. Right. So if you specified physical delivery, you are guaranteed a revenue of 1.3 million, and you're guaranteed to pay 1063 to buy your pesos. Assuming there's no risk on the revenue and cost side, right? As long as your supplier in Mexico says, oh, it's 21 million pesos and your revenue turns out to be 19, let's assume that risk away. You have a strict contract. I'm going to pay you 20 million pesos for the widgets, and then you have a contract from the bank that you will pay 18.8045 to buy the pesos. So your profit is locked in at 244. All right, it's a good way of thinking about it. All right, now I have to make things superficially complicated, only to help you get through the case study next week. All right. Take a sip of coffee.
Yeah,
2 sips of coffee. It is helpful. Yeah. It's an interesting case. I think you can do a lot with it, even if you don't get the exact solutions by talking. All right. But I think it would be a challenge to kind of set up those spreadsheets to try to figure out their cost after they hedge. It basically looks like this next couple slides. All right, so here's where it gets just a little nasty, just a little bit, all right. Most forward contracts on currencies are what we call physical delivery. In other words, you literally wire them £1 million and they wire you $1.3 million in dollars. You wire them $1,063, they wire you 20 million pounds. That's what most of them look like. And they call it physical delivery. That's what you expect to happen, right? However, some contracts are called cash settle. What cash settle means, you don't both exchange the currencies. You just figure out who won and who lost, and one party sends a check to another based on who won, who lost. All right? So here's what that would look like. If this were a cash settlement contract, all right, in this case, on my PA widget is buying, what currency are they buying? Buying pesos, all right, and they're selling pounds. So in the case where they're buying pesos, if it's cash settlement, meaning the contract doesn't require exchange of currencies, you just do this calculation. Take whatever the exchange rate is in 1 year, we'll call it ST, spot price at maturity time T, minus whatever the forward price is, all right, 18.8045, times my 20 million pesos. All right, my 20 million pesos. So just take whatever the exchange rate turns out to be, minus the forward rate, minus the quantity. Now the forward rate and quantity, they're set a year in advance. So the only thing you wait for is see what the exchange rate is next year. And then whatever that number turns out to be, if it's positive, you get paid. If it's negative, you pay the other person. It's just like a profit calculation. So say the exchange rate turns out to be exactly 18.8045 1 year from now. Just dumb luck. No one pays anyone, you just walk away. But what if the exchange rate turns out to be 20? The exchange rate is 20. Well, 20 minus 18 times 20 million, you're going to get paid. But what if it turns out to be 12? Well, 12 minus 18, you pay somebody. So these are cash settlement contracts.
So you have to pay them the spot rate today and then the difference comes out later?
No, it's simply this calculate. Nothing is paid today. Nothing's paid today. You either receive money or pay. You either receive dollars or pay dollars a year from now. That's it. So in this case, it's more like a Las Vegas bet on the exchange rate. It's a Las Vegas style bet on the exchange rate. If the exchange rate goes above this, you get paid, and if it goes below that, you pay. That's all it is. It's a bet on exchange rates, a side bet on exchange rates.
Talking about paying the bank that you contract.
Right. Yeah, the bank you contracted.
So if you pay it at the beginning, I would think, okay, well, they have certain money to invest in. So how do the bank makes money? Like
The only way they make money, they make money in the difference between these two rates.
By the
That little bit.
Exactly.
So hopefully, if you're buying 20 million pesos from them, someone else is doing the opposite trade, and they're making that 0.003 spread.
Yeah, so they are not expecting to make money because of the difference in the reality of the exchange rate.
They're just trying to. They're a middle. They're a middle.
They are winning by selling.
They're a middleman, right? They're buying currencies and selling currencies a year from now.
Yes.
And hopefully they're buying them all at a lower price than they're selling them all, because these are the two exchange rates, and they just make money on that spread. That's how they make money, a little bit of money.
But regardless, the bank is paying the company 20 million pesos.
No.
How does the company that they...
We'll get there in a minute. Rachel.
Yeah,
Why would you do it?
you can't not pay anybody.
Why not just exchange the currencies? Well, let's work through the example and we'll see if it looks easier. All right, so let's work there. Ryan.
So I get the Las Vegas, gamble example, but like if it's a forward contract, why would you enter into it if you knew you were going to lose?
You know what they're going Let's work through this before. Let's work through this.
That was the whole point of the
All right, so everyone loves the physical delivery, right?
Yeah.
You're guaranteed your profit, right?
Yes.
Everyone loves that. What I'm about to show you is it doesn't matter if it's cash settled. You're still guaranteed your profit. Let me show you the magic. The magic man. I'm the magic man. All right. So let's take the pound one first. All right. So where are they on the pound? They're a seller of the pound, right? And they're a buyer of the peso. So let's look at this contract right here. So they could enter into a contract where they will deliver £1,000,000 and receive $1,308,000. Right? That makes perfect sense to everyone. The world is normal, right? But they're going to do. In this case, we call them the short counterparty. They'll deliver the deliverer of the foreign currency. They're delivering the foreign currency. They're receiving dollars. Their payoff, PA Widget's payoff, is the forward price, 1.3083. That's negotiated up front, minus whatever the spot price turns out to be times $1 million. That's their payoff function. All right, now first tell me, are they exposed to the exchange rate going up or down? All right, forget about the forward contract. Pretend they don't have a forward contract. Do they lose if the pound appreciates or depreciates? Forget about the forward. Depreciates. So if they want a Las Vegas style bet, they want one that pays them if the pound depreciates, right?
Yeah.
If the pound is less than 1.3083, this contract pays them. That's the trick. Because the forward price is, in this example, 1.3083. That's negotiated day one. Next year, what if the exchange rate turns out to be 120? If they were not hedged, they are totally screwed, right? Because they're not going to get 1.3 million, they're going to get 1.2 million. Right? That's bad. However, look at the magic. this contract that's cash settled, the payment is the forward price, which is set, and the quantity, which is set. So you just wait around and see what this is. It turns out to be $1.20. They get sent a check for $108,000 from the counterparty. The bank. The Goldman Sachs, the BAML, the whoever. They get a check for $108,000.
Yeah. Which is what they lost.
Right. Now, let's see what their total cost or total revenue is. All right, well, crap. They only got $1.2 million. They're going to still sell their £1 million into the spot market and get only $1.2 million. So they only got $1.2 million. But they got a check for $108,300. Here's why I'm the magic man. Oh my God, that's the same number. It doesn't matter if it's a physical delivery or cash settlement. By setting up a payoff function of the forward price minus wherever the spot price turns out to be times $1 million, it doesn't matter what the exchange rate turns out to be. They will always get exactly 1.308300. It doesn't matter. So what I'm saying, so let's see if you understand this. Let's make another example. What if the exchange rate turns out to be, let's go really bad, $1? If they didn't hedge, what's their revenue? $1 million, which is 308,000 less. They're going to get a check for 308,300. What if Great Britain sinks into the ocean and the pound is worth 0? They get a check for $1.308 million from Goldman Sachs because then their pounds are useless. So it doesn't, once they have it, if it's financial settlement, it just doesn't matter. And actually it's kind of easier. Instead of, all right, I'll deliver you £1 million, you deliver me $1.3 million. I don't know why I use that voice, but.
But if you're going to six in the ocean, who are you going to deliver the goods to?
Oh, forget about that. It happened right after they deliver the goods and they give you the $1 million. That's when the volcano in Great Britain explodes and they go into the ocean. All right, just forget you. Go ahead.
So I can explain this to my 9-year-old. So basically, this is like if he owes me $2 and I owe him $3, and we exchange, he gives me 2 and I give him 3, versus you just give him
The net, yeah.
That's the difference.
Right. Yeah.
I get it.
So it's almost like taking a Las Vegas style bet in opposite of your risk position, but really when you put it back together, you're risk free.
So it's really not a bet.
It's a bet in the opposite direction.
Yeah. Because if it increases.
If you don't get the hedge, you do have a bet that the pound doesn't devalue. So you're just taking an opposite bet that pays you if the pound devalues. You're just putting 2 bets together. One is your business bet, and one is this financial derivative bet, but you put them together and the risk just magically disappears. Rachel.
Settlement is only on the difference.
Yeah.
And then you're kind of on your own to get the...
Yeah, you're on your own to sell the pounds in the market. All right, let's do the opposite. All right, here's when you really know you got it. All right, what if the pound, all right, so here's what you know. What if the pound is worth $2?
So you're going to receive $2 million, but you're going to write a check for...
You're gonna receive $2 million when you sell the pounds.
You're going to write a check for...
You're going to write a check for about $700,000. You're going to get $1.3 million. You're sending $700,000 to Goldman Sachs. But so whatever happens, you get 1.308. It doesn't matter. You're guaranteed 1.308, even though you're not exchanging 1 million pounds for 1.308. So, question, why would I want cash settle or physical delivery? Sometimes it's specified, it's out of your control. Sometimes, and this is important, the Chinese yuan, the government, due to their manipulation of the currency, does not allow yuan outside of China. So the only way to get a forward contract on the yuan is to get one of these. So all contracts which are barred from leaving the country wind up being cash settled. Does that make sense? So literally you could not say receive pounds in New York, or I'm sorry, yuan in New York, because the government of China would not allow it. So this is a way of getting around it. Also, it's just kind of easier. I don't have to wire you pounds. We'll just figure out who won, lost, and send one check. So one check's better than two checks, right? So that's it. Yeah.
Yeah, so I guess the way I see it is, you keep on saying it's a bet, but this is a mitigation for not playing the FX game, right?
Exactly.
It's the revenue. That's what your business is based on, is the revenue flow from doing that transaction.
Yeah, but be careful. I think a big concept from me using the word bet is if you don't put it on, you already have a bet.
Right.
You already have a bet that the pound doesn't devalue, so we're just taking a bet in the opposite direction. Now they offset each other. Now I'm not. So I have two bets.
Right. But as
two opposite bets.
As an organization, though, you have the peace of mind that you know what you're going to get.
Exactly.
Yeah.
Ryan?
So, in like, let's say huge global corporations, right? Do they look at the exchange rates and say, hey, look, we think the pound's actually going to appreciate next year, so we're going to not lock it in? Like, do they play the game like based on how?
I think they play the game a bit. I don't think they should. I don't think they should. I think they do, but they shouldn't. All right. Who's the one that says they buy engines? You buy engines, right? Or whatever, motors. So why don't you just wait and see what motors are selling for next year and then put it together? Right, like why? So why would you not lock in the price of a pound? Why would you not lock in the price of a peso? It's a cost of production. You need pesos just like you need motors. So I don't know why they play games with currencies when they don't play games with motors. It's the same thing. I need, again, what if your motors are coming from Mexico, right? Well, you need motors and you need pesos. Those are your two costs of production, right? So why wouldn't you lock both of those prices down? I don't understand it.
Because one of the reasons why you wouldn't do that and it becomes an optics is that on that situation, you don't get to actually record sales until a year from now. But if you take it forward out, you need to record its gains or losses, and they don't like to see those.
Not necessarily. So good question. Sometimes if you enter into a forward contract a year ahead of time, gains and losses on the forward contract could, as the exchange rates are bouncing around, the forward contract gets revalued and can show up in the income statement. You can avoid that. You get something, hedge accounting.
Yeah, but you can't get hedge accounting for that. You can only get hedge accounting when you have an actual exposure on your books. So
well, let's pretend this is a contract. You have a payable and a receivable. So yeah, you're exactly right. So he's talking about is a very technical thing called hedge accounting. So if you're trying to not show gains or losses during the year, so he's exactly right. If I don't have a payable and a receivable, if I don't have today, like time period 0, if I don't have a payable and a receivable, and I go ahead and I put on these forward contracts, every quarter when the exchange rate changes, I could show a gain or loss going through the income statement on just the derivative, just the forward contract. But if you have a receivable and payable today, you can match it up with the forward contract and get what's called hedge accounting. Therefore, no gain or loss shows up until the actual payment in 1 year. But you're absolutely right. If this does not have a payable or receivable, you're kind of screwed. Yeah.
Then you could what do? They say, well, sales went down because the currency.
Yeah, so you have to so you try to get a payable, try to get some kind of commitment to pay and a commitment to receive, and kind of put it together. Susan.
So just the spot price for using the data.
This one? No, that is whatever the exchange rate turns out to be next year, which I have to wait and see what it is.
No, that's what I mean.
Yeah.
Next year.
Yeah. Yes.
I'd like to see you deliver.
Yes.
Today, whatever the exchange rate is today. That's.
Today, a year from now. Yeah. So it's the spot price 1 year from now, which will only be known in 365 days.
Right.
Yeah. So you know F, you know Q, and you just wait around for ST. Yep. Corey.
Why would you not catch?
Oh, not what?
Why not? Why wouldn't you prefer a cash settle? It seems a little bit easier. I don't know. Because it seems complicated for non-finance people, I guess. It seems easier, like wow, you know, like every other thing you do, when you buy motors, you don't have a cash settlement contract on the motor, you have a fixed price. So why don't you just have a fixed price on everything? So I don't know. I don't know why. Yeah.
Is there an advantage? Like, is there any way to mix it where you don't lock in the entire transaction under a forward contract? Like maybe absolutely. So good question. That's what the case is about. The last little nuance of the case. So here's the other advantage to doing it this way. I'm glad you brought this up. What if you are due 1 million pounds, but you're not really sure? Could be 900,000 pounds, could be 1.1 million pounds. So here's what you can do with a cash settle contract. It's kind of nice to model with a cash settle contract. I know I expect to receive 1 million pounds, but you know what? Let's only put a forward contract on 800,000. Right? The nice part about modeling it this way is you could set this up. The forward contract is, say, 0.8 million. All right, but you still expect to receive 1 million pounds next year. I'm going to show you this in a minute when I show you the spreadsheet. Is most firms actually, that's what they do. It's called a hedge ratio or coverage ratio. So a firm with, say, 1 year expected pound revenues, they generally have coverage ratios of between 75 and 90%, which means for every dollar of expected revenue, they're only going to put a forward contract on 75 cents or 75, or what are pound cents called? Pence? What are pound cents? Are they pence? Yeah, so I think it's pence. So they put a contract for every 1 pound expected revenue, they're only do 75 pence contracts. So they call that a coverage ratio, and it's largely there because they're uncertain about the quantity. Like they don't. So that's the advantage.
The only advantage is that the quantities don't really come through. You know, say the actual million, you don't overhedge. Even though in theory you should just put a forward contract on the expected amount, and if you don't really get them, it doesn't matter. So yeah, but most companies have a coverage ratio.
You're still playing. I mean, you're still playing the game, right? On that little.
Well, they would say.
Yeah,
If so, you're right. If 1 million is the expected value, why would you? And so it could be more, it could be less. That's the definition of an unbiased expected value. It could be more, it could be less, but that's your best guess. That's what you should be hedging. But firms don't do it. They always hedge 80 to 90% of that number. So, and the reason is actually a little complicated. It's not technical, but it's more human nature. Shareholders understand your business. They understand you receive pound revenue. So when the pound devalues, they expect to see maybe losing a little money, right? Here's what happens. You expect 1 million pounds, you get a forward contract on 1 million pounds. However, you only wind up getting 700,000 pounds. But you have this contract that paid you a bunch of money because it devalued. So now you're stuck at a shareholder meeting explaining why you made money when the pound devalued, and you have to explain because you overhedged. It's like, it's not even worth it. Let's just do hedge 80%. I think it's just human nature. It's like they don't want to have to, again, they're exposed to the pound depreciating, but if they wind up hedging a million and only 800,000 comes through, and then they show a gain that's actually, the gain's actually bigger than the loss on the actual position. And then the shareholders are like, what are you talking about? You guys are speculating on currencies. But they can somehow handle like, oh, well, you didn't hedge it all. You're okay.
That actually makes sense because, if it's like a German company, and the euro takes the hit, they expect it to go down.
Yeah,
but if it makes a...
Yeah, and you actually sound like a superstar. Hey, if we didn't hedge, we lost 1 million. We only lost 200,000 versus like, yeah, devalued. Yeah, we should have lost, but actually we took some bets in the opposite direction. They turned out really well. We actually made money. You're like, what are you doing? What are you doing? you're making widgets. You look like you look like a hedge fund. What are you doing? Yeah.
So if that happens and you get less revenue than you expect and what you contracted for, you have to buy those pounds at
Yeah.
whatever the spot
Yeah.
market is.
Yeah. The cash settle kind of calculation does it. It kind of does it for you. That's actually even if you're doing a physical delivery, I still model it as a cash settlement, which is just easier to model in a spreadsheet because you can divorce the actual expected quantity from your hedge amount because they could be different. All right. What? No, that's the easy part. All right. Before I go to the hard part, let's do the same thing for the peso contract, just a forward contract. They are going to, are they buying or selling the peso? Or if in the forward contract, and they need to buy or sell pesos. They need to buy pesos to deliver to the Mexican subsidiary or Mexican supplier. So they're going to be long. So their payoff on their forward contract is this. Whatever the spot price turns out to be, by the way, there's always has to be direct here. Dollar over FX, dollar over pound or pesos, minus the forward price times the quantity. All right, so instead of F minus ST, it's ST minus F if you're the party buying the currency. Then take the difference in the exchange rate. So say the exchange rate turns out to be 15 and not 18. All right, well, they get paid $269,000. First of all, if the exchange rate goes from 18 and it turns out to be 15, is that a devaluation or appreciation of the peso? It's an appreciation of the peso. That's bad, right? That's bad. They get paid. So when they go and buy their 20 million pesos at that shitty exchange rate of 15, it doesn't matter because they just got a check from BAML or Goldman Sachs for 269. They're still paying $1,063,000. They're locked in. So it doesn't matter. It's just the other side of it. They're locked in.
So that's all we're about. Yeah,
locking it in.
So we can forget about the details at this point and just say it doesn't matter.
If I didn't give you the spreadsheet, I'd say yes. All right, this spreadsheet is doing nothing but the exact formula I gave you. Where'd my thing go? Double click.
So you miss out on the growth that was to go.
All right. All right, you in here?
Yeah.
All right. This is my pound revenue, right? What if the exchange rate, if I'm unhedged, what if the exchange rate is 110, 115, 120, up to 150? Well, my revenues are 1.1 million to 1.5 million. You everyone okay with that? All right, it's £1,000,000 times $1.10 times $1.15. So if they don't hedge, this is what their revenues look like at different exchange rates. Okay? That's if they don't hedge. Now, if they do hedge, they'll get exactly 1.3 million. We said that, right? Well, here's the magic. Here's that payoff function. F, the forward price, 1.3 million, minus whatever the spot price turns out to be next year times 1 million pounds. So if the exchange rate is less than 130, they get a bunch of checks. They get checks from Goldman Sachs. If the exchange rate turns out to be above 130, they pay Goldman Sachs. Here's the magic. Look, this is when it adds it all up. It's always $1.3 million. It looks exactly as if they had a physical contract where they exchange 1 million pounds for $1.3 million. Is that good? So look, this is what their exposure looks like to the pound. There's no exposure. No matter what the exchange rate, they will exactly get 1.3 million. All right, now here's a little insight into the case. The benefit of doing it this way is this equation here could be based on expected revenues. This equation, which is a million revenue, right? 1 million pounds. This one could be based on, say, 800,000 pounds because you don't want to cover 100% of your expected revenue. So there could be a difference between how much you expect to receive in pounds versus what you wind up hedging in pounds. So you basically have, a cell that has the expected amount you're going to receive, but another cell is how many you actually negotiate it with the forward contract. And you'd have a little bit of exposure just because you're not 100% hedged. All right, so use these spreadsheets for the case. It's going to be kind of modifying them. All right, and you okay? And here's just the peso one. If you don't hedge and you have to buy 20 million pesos and the exchange rate is somewhere between 16 and 20, you'll pay between $1 million and 1,250 and $1,250,000. That's what you'll wind up paying if you don't hedge. But you get this contract with Goldman Sachs, which is the difference in the actual exchange rate. I flipped them all to be dollar per peso, times 20 million pesos, and you pay, or you get paid or you pay. But in the end, it doesn't matter. As long as they're based on 20 million pesos, you'll pay exactly 1.6 million, which means your profit will always be $244,000. All right, now, the only advantage of me showing you that payoff function, F minus ST times Q or S minus SF times Q, one is you have to actually use that for the yuan, which is the primary supplier in the world, because you literally can't get a physical delivery contract because of restrictions from the Chinese government. Two is for modeling purposes, it is just so much easier to set it up with that little formula. All right, and also when you start varying the quantity you're going to hedge. It's just a way to set up the spreadsheet. So that's everything I know about forward contracts. All right, now options. Should we plow through this or you want 5 minutes? 5 minutes. 4:40, 7 minutes, 4:40, and then we'll take, because it's about 20 minutes, 15, 20 minutes on options, but you need a little break. 2 more coffees. Do not come back here without 2 more coffees, all right?
I know, that's what I said, like, that's what I said before. Oh, I didn't. Outside the concert.
I don't think I have one. It's very hard to make it back.
Here's the deal. I'm just trying to think. Here's the deal. The risk of it is that currency you're just all it is. Yeah, if you let it go down,
Yeah.
you lose a lot.
I noticed that if you put it in the spreadsheet for exactly what the spot price is, that formula comes out to 0. If you look, see 1.3L, 1.35, so there's a positive and negative in the payoff. Either payoff to be absolutely 0, one way or the other. This is exactly
Yeah, that's right.
Oh, exactly.
Yeah.
Yeah, 2 weeks. And then if you let me go. Tomorrow. Okay. But I love it. Don't think about that, Corey.
that I will think about it in terms of the stress level. That's also I think I'm gonna try to set up. We'll see if that actually happens. Yeah.
Really interesting to see. You know, I did that.
I mean, there's a self-selection sorting process.
That's what she really right? And now they're together. This one she's pregnant. Yeah, he's moved up. Because he switched religion. And whatever religion he is, he has to do that.
See, we did this one for a long time, so we're there ups and downs, and like how they change. I mean, I really, I'm not the same as I was. 3 or 4 years ago. I mean, it's when God makes us stress, it just gets worse. Yeah, I'm really looking forward to it. I think
But then you'll get married, and you're gonna have kids, and you're gonna go overseas.
yeah, but those are like except like those are like not for I can definitely see myself I can't do this. Unless I get fed, I want
And that's what I said, oh, stress is gonna be done.
It's a different, it's a different one.
I'm the second word.
Like a little more. This one is.
Yeah.
There's nothing before.
Yeah, she did say it.
Very quick announcement. I interrupt forward hedge sensitivity.
which I remember everything about, of course.
I can pretty much deliver the lecture. I can step in.
Lou had to go. So let's talk about.
You know what, Jason? Now that you said that, I think I did see you one day, but you already passed me.
Oh, yeah?
And I was thinking, who's Jason? And I was like, yeah.
Yeah, I think when I saw it, I think you were actually like waiting to turn on the ridge, and I was pulling down. I was like, yeah. You're like, well, you're not expecting to see, like, you know someone from a concert is like,
Right.
you're expecting.
Yeah, because I saw you in the room, you didn't register until after you passed.
It's funny, they don't even recall it though. It's strange. Brain's a funny thing. All right, real quick, because I don't want to interrupt forward hedge something. All right, so next class weekend, so Penn State's playing Michigan, and it's the biggest home game of the year. And for those of you not familiar with Penn State football, they always take the biggest home game, and they'll do a whiteout in the stadium, right? So everyone will wear white. So we're going to white out the EMBA next Saturday. No, they said that in the other room too. And I've got a bus, and we've got a luxury box. Let's go.
I'll vote to teach it.
Yeah, I know. No, but we are. So I want to do a whiteout here. So on Saturday. White. I'm trying to see if I can get T-shirts done, like EMBA whiteout or something. I think it'd be
We're gonna wait. We're gonna go.
Yeah, we want to probably get ready. We're gonna pregame a little bit. White Russians.
I like that.
What time is it?
In class.
No, we're not going to.
Okay.
It's a night game. If we want to.
Hasn't been announced yet. I don't think it's announced.
It'll be like it's going to be.
Well, it could be 3:30.
Now, I'm sure it's going to be. So if we want to try to figure out some place to go, we can figure that out too. But I don't want to interrupt forward hedge sensitivity models.
Yes.
All right, guys, ready? Last 30 minutes. 20 minutes. Woo! Let's do it. All right. All right. Feeling good about this? Ready to step it up a little bit? All right. Now, unlike everything I've ever done in my core class and even all the lectures up to this, it wasn't very hard, just superficially hard, make it seem this is actually a little bit hard, right? This is why I'll charge you $1,000 an hour. All right, so this is the first thing that's actually getting a little bit hard, but now I need to step it up and do options. Ready to do options? No. All right. Now the big picture in options is really, really easy. But everything after it is really, really hard. So the big picture in options is I can enter into a contract to sell my pounds at $1.30, lock into that minimum revenue, right? And there's no, I don't pay anyone, right? Just we agree to exchange £1 million for $1.3 million, or have that cash settle contract. Right, here's why it's a little different. Another choice I have is to enter into an option contract. Specifically, it's called a call option. Or I'm sorry, a put option in this case. A put option is an option to sell one currency for another at an agreed upon price, just like a forward contract. But you can walk away. You can just not, I don't like that price a year from now, I'll just walk away. That's the only difference between a forward contract and this option contract to sell the pounds. All right. Now, so I guess one phrase people like, it's like a forward contract you can cancel at will, right? It's a forward contract you can cancel at will. Like, yeah, I know I signed it, but forget about it. That's what an option is. Now, the difference with an option, though, if you're going to get that contract, you're going to have to pay something today to Goldman Sachs to have that ability to walk away. Because that's the only way. Because the only reason you're going to walk away is because you get screwed. right? The reason why a forward contract, no one exchanged prices, because you're just as likely to get screwed or win. But with an option contract, once you own it, you can't be screwed because you can just walk away. So you got to pay something up front called a premium or an option cost. And a lot of times they're anywhere from a few percent or 5 or 6 or 7% of the total value of the currency. But once you have it, you can walk away. So I just need to explain what that looks like, and then explain that little nuanced formula to model it. And that's all we need to do today. And then the last thing I'll do is I have to go into explain a little bit of kind of how people value options. But I'm just going to show you the model and kind of show you how to play around with it. But just what Black-Scholes, who's heard of Black-Scholes? Right, Black-Scholes, so Black-Scholes option pricing model. I'll just show you the formulas. You'll have it in the spreadsheet, and we'll kind of talk about what it is. Pardon me? Generally, depends. If it's an exchange-traded option, meaning you bought it at the Chicago Mercantile Exchange, yeah, you can sell options. If it's just an agreement between you and Goldman Sachs, there's probably a clause that you both can't sell it. Right. So yeah. So it depends. If it's just a kind of an agreement between you and a bank, you can't sell it. But if you buy it on an exchange, you can buy it and sell it every day.
I'm just curious. If you had it and then you wanted to walk away from someone.
Yeah, if you did it on an exchange traded option. Yeah.
Why would you do that then? Why would you pay the premium up front so that you could maybe walk away later if it benefits?
Well, let's get away from our example here. If I'm simply a hedge fund or a day trader in currencies, I could buy exchange traded options on euros, make some money, and buy and sell them every minute. Why this firm would want one, I don't know. Right? They're just waiting around to see what the revenues are. So there's no advantage. I don't know why this firm would want one that you can buy and sell. All right, so that's the big picture. Yeah.
Is this related to stock options or not?
It is a stock option, except it is a currency option. So a stock option is an option to buy or sell a stock at agreed upon price, but you can walk away. This is just an option to buy or sell a currency, but you can walk away. So it is a currency option versus a stock option. Yeah. So you guys get stock options at work, where it's kind of here's a price, and if you exercise it, you get to buy it, but you only exercise it if you can buy it cheap, right? And if it doesn't, so say if say your company's trading for $20, your stock price, and you have the stock option to buy 1 million shares at $15, right? That's awesome, right? I'd buy 1 million shares at 15, immediately sell them for 20. Right? Well, you can do the same thing. What currency are we buying here? Pesos? You can have a contract to buy 20 million pesos at 18. Exchange rate is 18. And so depending on what happens to the exchange rate, you might want to walk away or keep it. So we're going to walk through that example. Okay.
Is there any
time restrictions?
Pardon me?
There's time restrictions.
Yeah, so you buy a 1 year option, a 1 week option, a 2 year option, a 10-year option. Yeah, and just as you would guess, the longer the period, the more expensive it is. All right, so I can have an option to buy the currency, but it expires 1 week. But I can have the option to buy or sell the currency a year from now, it'll just be more expensive. And once it's over, it expires. Is that your question?
Yep.
So they're usually tied to a specific deal.
Yes, but Goldman Sachs doesn't care. You call them, it doesn't have to be a deal, you could be a speculator. Doesn't matter. They'll take your business. Yeah.
But you can only execute that option on that date specified.
Well, there's two types of options, American style and European style. Some are set. For this example, you'd probably get what's called a European style delivery, meaning you say, okay, it's 1 year's the delivery. On that day, we'll decide what we want to do. That's called a European style option. But there are American style options, which means if you buy a 1 year option, every single day you can decide to say, okay, today's the day I want to buy the 1 million euros or the 20 million pesos. So you can decide it's American style delivery, where you get to decide every single day until it matures. We're going to pretend everything's European, meaning just on the maturity date, that's when you decide. All right. So they have all kinds of delivery. There's actually Bermudan style. They're kind of a hybrid between European, because Bermuda's between America and Europe. So it's called a Bermudan style option. It's like you can choose once a month on these dates, but only those days are once a month. On the 15th of every month, you get to decide whether you want to buy or execute the option. That's a Bermudan style. All right. We good? All right. Got your thinking caps on? All right. So now we're going to use options to hedge this. All right, so an option is the right but not obligation to buy or sell something. All right, right but not obligation. A forward contract is the obligation to buy or sell something. However, with a forward contract, it's basically just one contract, and one party is the buyer and one party is the seller, right? An option contract, you have either call options or put options. I buy a call option if I want to buy the current foreign currency, and I buy a put option if I want to sell a currency. So a call option is an option to buy a currency, and a put option is an option to sell a currency. So they want a call option on which currency? They want to buy what? Peso. They want a call option to buy pesos, or they want a put option to sell pounds, right? So here's the example. What if they can buy a put option to sell £1,000,000, and you negotiate, you know what, I want that forward price. So just give me that price of 130,083, to make it easier. Now I know the forward price is 1.3083, so let's just have that as the forward price. I'm sorry, we call it in option world, we don't call it the forward price anymore. We call it the strike price, or call it the exercise price. You just give it a new name. All right, so it's in forward world it's the forward price, in option world is the strike price or the exercise price. So now you're going to negotiate that I have a put option to sell Goldman Sachs £1,000,000 at £1,030,83. All right, which means they're going to exchange £1,000,000 for £1,000,000 for $1.3 million in 1 year. And that option is selling for 5.2 cents, which is a reasonable price. I'll show you why in a minute. So what that means is 5 cents times £1,000,000 is $52,000. So if I want a put option to sell £1,000,000 at $1.38 or $1.3083, I will first write a check to Goldman Sachs for $50,000 or $52,000. Goldman Sachs has the money. Now you are sitting on this option now, and you wait till next year. In exactly 1 year, you have a decision to make. Do I exercise, meaning do I force Goldman Sachs to take the £1,000,000 and give me $1,003,003? Or do I just tell Goldman Sachs, keep your money, thanks, see you? That's your choice. You got it? So effectively, they could act like they have a forward contract and exchange the $1.1 million for $1.3 million, or we're going to just walk away. But no matter what, they lose the $52,000.
So you would do that if the spot price on the day that was due was better.
Exactly.
Would give more.
All right, so put your thinking caps on. 1 year later, the pound is selling for $1.40. Do you exercise the contract, or you just go in the market?
10 cents per pound.
Yeah, if I go in the market, I get $1.40 per pound, so I get 1.4 million. If I exercise the contract, I only get 1.3 million. If the pound is $2, what do you do? Walk away, because again, the contract is locking into 1.3. Walking away means, I can get 2, I can get 5. So the advantage of the option is, if it goes in your favor, you make a killing. Now, what if the exchange rate is $1.05? Yeah. Goldman, I'm here to exercise my option. I'd like you to give me $1.3 million for £1,000,000, $1.30. Please, thank you. Literally, that's all you do. That's called exercising the option. So you only exercise it when it's in your favor.
So really, worst case, you can lose $52,000.
Exactly. So here's what us cool finance people say. You just bought a $52,000 insurance contract to guarantee at least $1.30. But you can do better.
Wait, or you can pay nothing to guarantee $1.30. You're not going to make more than that.
Right, but the nice thing about an insurance contract is you can do better. I'll get at least $1.30 minus $50,000, or I can make a killing. But I don't get killed. The only one person to get killed now is Goldman Sachs.
So why would
Why would Goldman Sachs do it? So they get $52,000 from 1 million people. And yeah, so, and they get enough people with calls and puts and kind of offsets the risk, so they don't really care in the end.
This is my example. I guess this is the way I'm thinking about it, though. Like, if I, like, over the last 10 years of paying car insurance, pretty sure the insurance company's done better than I have. Like, so I think about the same thing in this example.
An auto insurance contract is simply a put option on your car.
Right.
Where you get to sell them your car at a price if crash it and force its value to zero. So a insurance contract is simply a premium you pay to have an option to sell your car to the insurance company when it's worthless. Yeah. Right? Insurance contract in your house is a put option. Your house burns down to the ground, but you have an insurance contract. That insurance contract is a put option to sell the house to the insurance company for the full value, even though it's worth zero.
But for the car, it's beyond just the car. Right? You hurt somebody in that.
Yeah, there's also these benefits. Yeah.
Don't complicate it.
Yeah, don't complicate it. You're getting away with a good story.
Make sure you don't have insurance that just covers the car. Pick it up.
So you need to evaluate if this is better for you or the forward. Like, do you do?
So good question. This is a more of a bigger topic. Why would you do a forward versus an option? Why would you lock in 1.3 or pay $50,000 but could make more money? Chris.
If I would have to guess, I would say it would be where you have really tight margins. So you need like a
really tight margins, and you do what?
If you're a manufacturer.
But you get the forward or the option?
Forward. I think the option is going to be a profit.
All right, so you're saying if you just want to lock everything down because margins are so tight and you can't afford the $50,000, maybe that'll kind of push you over. I think you're right. I would get a forward.
What about the whole soft currency, hard currency? So it's soft.
A little bit of speculation. You know what? I think there's going to be a soft Brexit. I think the Germans are going to let the British have a sweetheart deal, and I think the pound's really going to appreciate. I think it's going to be selling for like $1.80 next year. Let's pay the $50,000 and take the chance. Maybe we'll make some money. It's a little bit of speculation, but it's speculation that you can't lose. I mean, the only thing to lose is $50,000.
Yeah.
So I think you're right. Sometimes it's like, you know what? They're just risk averse. Let's just I don't want to think about it. And the other one is like, it's a little bit of a gamble, but it's a gamble that you can only win once you pay the $50,000 sunk cost.
I think of like the example you did with the 80-20. The sunk cost, nobody really thinks about it after it's done, right? So for a stake, for shareholders and executives down the line, you equal 50 or 100 or 200, whatever up front, and you guarantee that.
Well, you still have 50K.
No, but that's what I'm saying is it's up front, so it's sunk cost. So a lot of times.
Well, it's only sunk cost after it's sunk cost. Like, the decision to buy it, it's not sunk cost yet. So the question is, should a shareholder want you to buy an option?
I think it's easier for the finance person to say do it and then
do what?
Buy it.
Buy the option.
Yeah, buy the option because
over the forward.
Right, because at that, I definitely agree with the more risky scenario. But at the end of the year, it makes it easy to justify whatever happens to that FX, right? Which I think is something that they're more interested in.
Oh, maybe. Yeah. I mean, I hear what you're saying, but I'm not. Now we're talking about, at this point, we're not talking about finance. We're talking about psychology. Like, would you rather have upside and justify gains, or?
Well, the 20% thing is kind of what I was thinking, right? So that makes sense to me. I mean, they're okay with knowing that they're going to take a loss, but let it have a gain.
All right, let's see what Rachel has to say. Rachel, go ahead. Mm-hmm. So well, if you had no money though, you can't afford the option.
Yeah.
Well, if you're pessimistic, just get the forward. right? If you think it's going to go down, you think you're going to waste your $50,000. So a lot of it is kind of your view on the exchange rate. Is there more upside than downside?
I thought on options that there was a time frame that you guys would exercise.
Yeah.
Yeah. Made the risk greater for the game. It was like,
No, I mean, the idea this is set up is exactly 1 year you expect to receive £1 million. So you get a contract, an option contract that expires exactly in 1 year to sell them.
you can make a decision between that.
Or on that date, yeah.
Or on.
Yeah.
Right.
Yeah.
I'm good.
All right. You had something to say?
Yeah.
All right. So this is an option. What I'll tell you is 90% of the hedging is done with forwards. 10% with options. One reason is, a simple reason, is a lot of the hedging is done by a Treasury Department, and the Treasury Department a lot of times doesn't have budget. So they literally don't have budget. so they can't buy an option, so they wind up doing a forward. All right. This is cool. This is the Black-Scholes model. By the way, this is the actual formula that I put in VBA. So you first calculate something DN, which is the natural log of the spot price over the strike price, plus R interest rate minus the dividend yield over the volatility square divided by 2 times T, divided by V times T times the square root. Calculate ND1, which is a function of D1. Then you calculate D2, which is a function of D1. And then the value of the call is the stock price times the future value or the present value of the dividend times ND1 minus the present value of the strike times ND2. Right, it's obvious. and there's your put. All right. Now I will say we didn't do Black-Scholes last year, did we?
No.
All right. So Black and Scholes are economists from where were they? MIT and I forget where. Anyway, they're financial economists, kind of applied mathematicians, and they're working on the problem of trying to price an option. And pricing an option is something an economists were trying to do for about 100 years, and no one could figure it out. So this Black and Scholes, really smart. Again, they're like applied math people at the best schools in the world, working on the problem for about 5 or 10 years. They got really close, but they couldn't figure out the math. They literally could not figure out the math of trying to value the option because it depends on what the stock price is going to do, and the stock price depends on the volatility. So they couldn't figure out the math. So they give an early version of their paper, Black and Scholes, to this guy named Bob Merton. Now, Bob Merton is a really, really smart guy. A smart guy that applied mathematicians at MIT look up to. And he says, that's an interesting paper. I found a way to solve it. How I found that is I was reading this paper by Ito. And Ito is a physicist in the Japanese space program, and he's developed a thing called Ito calculus to track where their rocket ships are to place their satellites at all points in time. He developed this thing called Ito calculus, which then can track a satellite or a spaceship at any point in time and can tell you exactly where it is. I'm going to apply Ito calculus to your problem. And there's the formula. So it's treating the stock like a rocket ship, and it can figure out where it's going to be in the future, and based on that, it can predict the value of an option. So what I'm saying, this is literally rocket science. All right. So everyone else says it's not rocket science. This is rocket science applied to the forecasting of where stocks are by treating stocks like ships, rocket ships.
How accurate is it?
Well, I'll tell you this. Let's go to the...
One of the lessons from the last finance class was if there was a tried, true, solid method, you'd all be million.
Here's the formula. It's in this spreadsheet here. Enable macros. So if I plug in the current spot price of the pound was 129 the day I did this. I'm looking for a $1.30 strike, matures in 1 year. The expected standard deviation of the exchange rate is 10%. I got that from historical average. The U.S. interest rate is 1.22% for 1-year treasuries. The British rate is 0.1%. You plug it in Black-Scholes, and it tells me the put is worth 5.2 cents. The call is worth 5.1 cents. That's just applying the formula. Is it accurate? Within months of publishing the Black-Scholes and now Merton paper, traders on Wall Street were carrying calculators of this big in the early 1970s that all they did is they plugged in those 6 numbers and it spit out the Black-Scholes. And that is how people were pricing options. And if you use these prices, it's going to be pretty close to what you see when you actually go to the Chicago Mercantile Exchange or call banks. So this is what everyone uses the value options. But that doesn't help very much because, yes, I know the stock price. I know the currency price today. Yes, I know 1 year is the maturity. Yes, I know I want a strike price of $1.30. Yes, I know the treasury. Yes, I know this. So the model all comes down to what is your guess of volatility. If you think the volatility is going to be 20%, you'd pay 10 cents for the option. If it's 5%, you pay 2 cents for the option. So even though it may be a beautiful model, it all comes down to guessing what standard deviation is, which no one can do, except there's other models for guessing standard deviation.
Isn't that going to refine itself?
Yeah, and it has. There's all different variations of the model, models that treat standard deviation different. So this is the model. This is the standard model that everyone starts with. So if I had to price an option, I just want to get a kind of a fair price, I'd probably get the 3-year average standard deviation of the currency. That's pretty easy to do. Download prices, use the STD function, you're pretty much done, right? Plug it into this model, get the treasury rate, get the British treasury rate, plug it in. That's probably a starting price in negotiating with Goldman Sachs. And they have the exact same model on their side. And this model is so pervasive that when I worked on it, I used to oversee an options trading desk, right? When I had a real job. And if I called and asked, hey, where is the 1 year $1.30 strike pound put option selling? You know what the guy at Goldman's going to tell me? He's not going to tell me 52 cents. He's going to tell me this, it's trading at 10. What he means is it's trading at 10% standard deviation. Because we're all using the same model. So all we're doing is trying to figure out what standard deviation to plug in. So actually he says it's trading for 10 vol or 10.1 vol. They're literally just quoting each other the standard deviation in the Black-Scholes model. And that's how you actually discuss whether options are expensive or cheap. 10 is kind of a normal standard deviation for a currency. If you just look at all currencies, they're like 9 to 12. So if it turns out it's 12%, oh, that seems a little expensive. All right, so that's Black-Scholes. By the way, Scholes and Merton got the Nobel Prize for this. All right, Black did not because he was dead. You can't get a Nobel Prize when you're dead. All right, so also Scholes and Merton went on to found one of the biggest hedge funds of all time in the 1990s, long-term capital management. Did you hear it? Ever heard of it? At one point in the 1990s, it had $500 billion of positions. They almost all went bankrupt in 1998 when the Russian debt went bankrupt. Or the Russians defaulted on their bonds. And that little hedge fund was bailed out by all of the banks in New York because they felt that if that hedge fund was allowed to fail, it would bring down the world financial system. Because they had so many positions. So that's the history of the Black-Scholes model, Scholes and Merton, long-term capital, and how they almost destroyed the whole world economy. And they're still rich, running their own funds today. Yeah. Gotta love finance people. All right. So 5 minutes, all right? So I only have a few slides. 3 slides, sort of. All right, so let me just kind of give you the short version of this. We said that, I don't want to write on the board because, I'm recording. So I said that if you want to model this, all right, in a spreadsheet, if you're doing a forward contract, right? If you're doing a forward contract, a long forward contract, in other words, you're the buyer of the currency, you just say the payoff is ST minus the forward price times the quantity. Remember that about 20 minutes ago, 30 minutes ago? All right, that's a long forward. What if it's a call option? All right, well, if it's a call option, we could say, well, it's either ST minus, we don't call it forward price, what do we call it now? We call it strike price. Sometimes use X, sometimes use K, times Q. So if you make money on an option, you will make the difference between on a call option, ST minus X, or you'll make what? Or 0 minus the cost of the option. So a call option is a little tougher because it could be 0, or you could make ST minus F. Actually, if this is positive, that's the answer. If this is if it's positive, it's the answer. If that is negative, that's the answer. So it's either 0 or ST minus the strike. As long as ST minus the strike is positive, that means you'd exercise.
Still need to subtract the cost?
Yes, because the cost is a sunk cost, but if you're getting your total cost.
From the top.
From the top.
From the top. Still need to subtract.
This one, there's no cost of a forward contract.
Hold on.
The center one.
Positive.
Oh, I'm sorry. This is like in addition to these two. So yeah, you can put the cost first. It's minus the cost plus either one of these. Is that better? Yeah. So it's the cost and either 0 or some benefit. So how am I going to do that? In my spreadsheet, instead of using, that's hard to see, but instead, if you can click on there, instead of using ST minus F times Q, I use a little math function in Excel, which says the max of 0 or ST minus F times Q. That's all I do. All right, so what this little formula says, I can't make this any bigger here. It just says the max of 0 or ST minus the strike price. Or F, this one's the put, so it's F minus ST. So all it does, if that number turns out to be 0, like a forward can be, it just puts 0 in that cell. And that's how you model calls and puts. Instead of using ST minus F or F minus ST, you just say the max of that or 0. And it's modeling your decision to exercise. It's literally modeling your decision to exercise. If for a call option, if ST minus F is negative, it says the answer is 0 because you must have not exercised. So that is the crux. So here's the end spreadsheet. If I enter a forward contract to what is this? The option or the contract to buy the to sell the pounds. If I get a forward contract, this is what my exposure looks like. It's flat. There is no exposure. But if I have a call option that costs me $50,000 to buy £1 million pounds at $1.30, if the exchange rate goes way down, I'm going to exercise the option and sell them all for $1.30. But I lost the $50,000. That little distance here, that's $50,000. The worst case is you'll do $50,000 worse than the forward. Best case, unlimited. So all this represents all those scenarios where you walked away from the contract and just took the really great exchange rate in the market. And I'll kind of finish with this graph here. And I'll let you just look at the formulas. This is just the only difference between these spreadsheets is this one little formula right here. This is modeling the put. All right, this is the expense. This is the call option on the peso. This is the call option on the peso. Instead of saying ST minus F times the quantity like I did with the forward, that was this formula here. On this one, I just said the max of 0, ST minus the strike. And it's modeling the fact that you either exercised or didn't exercise the option. All right, this might help you. Look at all these. Let's just launch this a little taller, and again, we'll be done in a minute. Come on, launch. There we go. this sometimes helps me think about it. See all these numbers here, 52,000? See all these 39,000? This is the cost of the option. This is the cost of this option on the pound. All these scenarios here are where you did not exercise, but you just lost your premium. All this call option on the peso, these are all the scenarios where you didn't exercise, but you wound up the cost option on this, of course, according to Black-Scholes, was $39,000. This is just you lost your premium, but things turned out really good for you, right? Because the exchange rate went in your favor, and you got to buy the pesos really cheap in the market. So again, this is the last thing we'll talk about here. This is the payoff if you get a forward contract. You have no risk. This is the payoff if you get, or the cost if you buy a call option on the peso. That the worst case is I pay that $39,000 more than the forward. Best case is the peso devalues and I get them really cheap. And that's the difference between options and forwards. All right, it's just kind of a little bet. If I think the exchange rate might go in that direction, maybe I get the option. And if not, well, maybe I'll just get the forward. All right, so next week, I'll post by tomorrow because I didn't know what I was going to get through today. I'll give you a little bit of problem set. And I'm going to rewrite the problem set tomorrow to kind of give you some problems that kind of look like the case. Then the case is due next Friday. We'll have a pink fuzzy Quizlet on Saturday. A little lecturette after that. And then I'll probably just send you home with a kind of a brief problem set. And we never talk about this again. All right, see you.
All right.